The SBA just doubled its lending ceiling to $10 million, and if that is all you heard, you are already set up to misread your own deal. That number is not one bigger loan. It is two separate loans, two separate approvals, and a sequence you have to get right, or the whole structure falls apart before you ever get to closing. Say you are buying a $7 million business, and half of that price is the real estate that comes with it. Under the old rule, whoever financed that deal needed conventional debt bolted on to cover everything above $5 million. Under the new rule, you might not need that at all if you understand exactly how these two programs actually stack together. That is the stacking rule reality check. 3 things you need to know before you assume any of this applies to your deal. Welcome to Main Street Ledger. I'm Kurt Rose, CPA, former CFO of an SBA lender and entrepreneur. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. For 15 years, once a borrower had an outstanding 7A loan, that balance reduced how much they could also borrow through the 504 program, which meant anyone using both programs together effectively topped out around $5 million combined. If a deal needed more than that, the buyer or owner went looking for conventional debt to fill the gap. And that made an SBA-backed offer slower and less competitive against anyone who could pay cash or line up their own bank financing without the extra layer. That changed on July 4th, 2026, when the SBA started letting eligible borrowers use the 7A program and the 504 program together at their full individual size, instead of treating them as one combined $5 million pool. On paper, that is a real shift for anyone buying a business with meaningful real estate attached, or anyone who already owns one and is financing an expansion that includes a building or a piece of equipment. But a bigger ceiling on paper is not automatically a bigger loan for you personally. Whether you can actually use this and how much of it still comes down to your specific lender, your deal structure, and whether the assets involved actually qualify under each program's rules. That is exactly why this needs a real answer, not a headline. Here's the stacking rule reality check. 2 loans, 2 approvals, 2 eligibility tests, why the details still depend on your lender, and where this actually helps you. That is what separates a buyer or owner who understands this correctly from one about to have a confusing conversation with their lender. Point 1, 2 loans, 2 approvals, 2 eligibility tests. When people hear the SBA doubled its limit to $10 million, most picture one bigger loan on one application. That is not what happened. The 7A program still caps out at $5 million per loan. The 504 program still caps out at $5 million per project. What changed is that a borrower can now use both at their full size on the same deal, where before a 7A balance ate into the 504 ceiling, and that only applies to loans that get their SBA loan number on or after July 4th, 2026, not deals already in process under the old rule. That means 2 separate approvals from 2 separate institutions, and each one is testing something different. The 7A side is testing the operating business, its cash flow, and its goodwill. The 504 side is testing the real estate and how it will actually be used. The SBA notice describes the 7A piece getting approved first, with the 504 following through a certified development company rather than a bank. And that is the pathway most lenders will actually run because a CDC generally wants the operating business locked in before it commits to the real estate sitting alongside it. Go back to our $7 million example, half business and half real estate. Before this rule, whoever financed that deal had to get creative to cover everything above $5 million, almost always with conventional debt layered on top. Now, in the right circumstances, both halves can be financed through SBA-backed programs instead. For a buyer or owner, the practical implication is simple. Do not walk into a lender conversation asking for a $10 million SBA loan. That loan does not exist. Ask how a 7A and a 504 would sequence for your specific deal, because that is the real question. And it is the one that determines what you can actually close. That covers the 2 loans. The next question is how much of it you can actually use. Point 2, the details still depend on your lender. This is where a lot of buyers and owners get ahead of themselves after reading a headline. This rule raises what is structurally possible. It does not hand every borrower automatic access to the full $10 million. The SBA still has its own rules about how much total exposure it will carry on any one borrower across its programs, and those rules did not disappear just because the combined ceiling went up. On top of that, every deal still has to clear the same fundamentals it always did. Cash flow strong enough to service the debt with room to spare, collateral that fits what each program requires, and a credit package a bank or CDC is actually willing to stand behind. A bigger ceiling is not a lower bar. If anything, a larger combined loan means your lender is going to look harder at the numbers, not easier. On a deal like our $7 million example, that bigger combined loan means a bigger monthly payment. And that payment has to pencil out against the business's actual cash flow, not the number on a projection. Think about what that scrutiny actually looks like in practice. Your projections get tested against a bigger monthly payment. Your collateral gets valued against a bigger combined exposure. Your personal financial statement gets reviewed with a bigger number attached to your name. None of that is a reason to avoid this structure. It is just the reason to walk in prepared instead of walking in excited. This is exactly the kind of detail that is specific to your deal, your lender, and your certified development company. And it genuinely is not something a video can answer for you in general terms, no matter how the headline reads. What this means practically is that the $10 million figure is a new ceiling, not a promise sitting in your name. Before you get attached to a deal structure that assumes you will get the full amount, have that conversation with an experienced SBA lender first. That conversation will tell you what you can actually use, and it will save you from building an offer around a number that was never really available to you in the first place. That is the caution. Here is where this genuinely pays off. Point 3, where this actually helps you. The businesses this rule was built for are capital intensive, the kind where the real estate and the operation both need financing at the same time. Manufacturers, logistics companies, food production businesses, and any buyer acquiring a business that comes with its own building rather than a leased space. Go back to our $7 million example one more time. $3.5 million is the real estate, $3.5 million is the business acquisition and working capital. Under the new sequencing, the 7 apiece can cover the business purchase and the working capital, while the 504 piece carries the real estate at a long-term fixed rate, assuming that real estate actually qualifies for 504 financing, which is a determination your lender and your certified development company make, not something to assume walking in. Owner occupancy is usually the first thing that determination turns on. The program exists to help a business own the building it operates out of, not to finance a passive real estate investment sitting beside the deal. When that structure works, it changes the picture at the closing table. A buyer who previously needed conventional debt bolted onto their SBA financing to close a deal like this can now, in many qualifying situations, put together a fully SBA-backed offer instead. That can mean more favorable terms on the real estate piece, and it can mean showing up to a negotiation as competitively as a buyer paying cash or lining up their own bank financing separately without losing weeks structuring a workaround. For a buyer or owner evaluating an acquisition in the $5 to $10 million range with real estate in the mix, the implication is straightforward. This is worth raising with your lender before you finalize your offer, not after you are already committed to a structure that assumes financing you have not actually confirmed. Let's bring this together. First, the $10 million figure is 2 separate loans stacked together, not one bigger loan, with 2 separate approvals and 2 separate eligibility tests. And the 7 apiece typically leads with the 504 following. Second, how much of this you can actually use still depends on your lender, your certified development company, and whether your deal clears the same underwriting fundamentals as always. This is a ceiling, not a guarantee. Third, this mainly changes the math for acquisitions between $5 and $10 million, where real estate is genuinely part of the deal. And remember, this only applies going forward from July 4th, 2026, as we covered. So a deal already in process under the old rule works differently. If your deal is under $5 million, none of this changes anything for you. But if you are structuring a $5 to $10 million acquisition with real estate in it, ask your lender about how 7A and 504 would sequence together before you sign the letter of intent. If breakdowns like this save you time, subscribe. There is more of this coming. Research the deal before you fund the deal.